expected pace of issuance and how many bonds they're going to be selling at auctions. So we're sort of, it's kind of a sense of deja vu, I suppose. And there's a couple of factors that are moving this. So effectively, just as equity investors have an equity risk premium and credit investors have a credit risk and premium, the way to look at the risk premium for bonds is, you've got to have a certain amount of yield that reflects the inflation expectation, the growth of the economy, and you want to have a bit of insurance. So what's the extra bit on top that you would demand? Now, all things equal, if deficits are rising as they are, you should be demanding more. What's really strange about the current environment is that the New York Fed model essentially says there's basically it's a very small, minimal amount of positive risk premium. And that's why a lot of people are very focused on this, because it seems to be a bit of an anomaly. Well, if you just look at the scale of the deficits, it should be a lot higher.
Well, in lay terms, I'm just wondering, so basically, Michael, what you're saying is if an investor believes there's higher risk in the future, then that investor wants to be paid more to own a 10-year.
Yes.
And so what's unusual is what you just said, that is it the New York Fed, in terms of what they are seeing in terms of risk, seems to be minimal. And yet the bond market or the Treasury market, U.S. Treasury market, is telling us something very different. So my question to you is, could that change very quickly on an election outcome or a data point or something? Or is that telling about worries potentially about an election outcome or a growing deficit? How do you read it? How do experts who really focus on the granular moves of the Treasury market, how significant is this, and what do they think it says?
Well, I think that the significant change in the last month, of course, has been the payroll report that came out in early October. I mean, the 10-year yield jumped from around 370 and got to about nearly 425 yesterday. It's come back a little bit today, but that's been a big rise. And that's because the bond markets had to wake up and say, you know what, the Fed's based on the current data, and we've got the Atlanta forecast for GDP running around 3.4% at the moment. This economy is not going into recession. The labor market is still pretty good. Unemployment at 4.1% is historically pretty low. So the bond markets had to reprice. And part of that repricing is that risk premium has actually been going up as well. And that, I think, reflects more about the fiscal outlook and the fact that neither candidate is really a fiscal hawk. They want to keep spending. One candidate in particular wants to do a lot of tariffs, wants to keep tax cuts. So the bond market is waking up to the sort of classic two things working against it. The economy is better than people think. It's a lot more resilient. The Fed may very well end up only cutting a few more times and having to sort of sell this idea to the bond market. You know what? The economy is strong enough. We probably can only cut rates to 4%. That means the 10-year will be above 4% along with the rest of the curve, which is what we've seen this week. Then the other factor here is if no one in Washington is really serious about addressing the fiscal situation, and let's face it, you're running a budget deficit at the moment at 6% of the economy. That's unheard of in peacetime. That's unheard of when the unemployment rate is basically at 4.1% and we're close to full employment. It's absurd that amount of money has just been pumped into the economy by Washington. And the bond market, essentially, if you get that double whammy, resilient economy and more spending, and who knows what's going to happen after next Tuesday, in 2 weeks' time, then you're going to see the risk premium really continue to keep going. And that's what the bond market is telling you. So this is the risk, and we're beginning to flag it.
What's the worst case scenario here? I mean, when do the chickens come home to roost? Because obviously neither
candidate... By chickens, do you mean 5 or 6%?
I don't know.
Like rates,
I don't know, Michael.
Well, I think it's it's a good question, Tim. I think I was talking to Rich Clarida over at PIMCO about this, and he said, look, the way he said it was, we're not going back to the 70s when it was much, much higher because we had a lot of inflation and there was a serious credibility issue around the central bank. And he also reminded me, look, Japan's had huge debts over the last 20, 30 years, and it hasn't had a problem with the term premium because there's been no inflation. So the worst case scenario is you have excessive spending continues, and you have the market beginning to question the central bank's credibility about inflation. Now, no one is questioning the central bank's credibility about inflation. So that worst case scenario, it only begins to come close to fruition if the central bank allows inflation to run hotter and doesn't react the way it did in 2022 and 2023 by aggressively raising rates. I don't think anyone sees that as a scenario at this time, but the deficits are a problem, and the bond market is telling you that the direction of travel is a higher term premium unless Washington begins to address the fiscal story.
Well, you know too, Michael, that I feel like there's a general public that hears this and like, what do I care about this? Like, we've heard this before. We've heard these arguments before. Bad deficit in the United States. And look, here we are doing just kind of fine. But what do you say to that?
Well, what I say to that, I mean, look, I'm someone who grew up watching American presidential debates. And the most stunning thing for me this year was the fact that no one talked about neither candidate talked about the economy, neither candidate talked about spending. And it just seems as if people seem to think you can keep on doing this. And you keep hearing the lines, well, you know, the United States is the reserve currency. Well, it is until it isn't. You know, the fiscal story will at some point erupt, and it actually will come from the bond market. The bond market will have, something will happen, and effectively Washington is currently, I think, sleepwalking towards a fiscal crunch. And when the bond market says enough is enough, look out for stocks because they'll take a big hit too if rates pick up.
Right, and the bond market's not going to be bashful about also telling you, you know, you push up those rates, right, and what the cost is on servicing all the debt that's out there, and that just makes it a bigger crunch for the government.
We don't want to be in a situation where Michael McKenzie says, I told you so.
I know, but you got to listen to him. Michael McKenzie, thank you. Rates reporter at Bloomberg News joining us in New York City. This is Bloomberg.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. 39 minutes to go ahead of the closing bell. The Dow lower, the S&P, NASDAQ, both advancing. Stocks up for the first time this week. Traders wading through a slew of corporate earnings for clues about the health of the U.S. economy. Right now, the S&P is up 14, up by about 0.2%. The Dow down 134, down 0.3. The NASDAQ Composite Index up 142, up by about 0.8%. 10-year 4.20%, the 2-year 4.07%. Spot gold up $18 the ounce, up 0.7%, 27.33. And West Texas Intermediate crude down 0.5%, 70.43 a barrel. The World Bank and the International Monetary Fund meetings are underway in Washington, where Bloomberg's Lisa Abramowitz caught up with IMF First Managing Director Geeta Gopinath, who spoke about the global economy and the level of uncertainty.
There are questions around what kind of policies will we have, depending upon the results of important elections, conflicts in the Middle East that could escalate, and you could see much wider regional tension, and oil prices could go up. What's going to happen to growth in China? That's another factor. So there are many risks. There's lots of uncertainty. Trade policy is also being discussed at these meetings quite heavily, and questions around that.
IMF First Managing Director Geeta Gopinath interviewed right here on Bloomberg Radio. United Parcel Service shares are surging after delivering better than expected earnings. UPS returned to sales and profit growth for the first time in almost 2 years. UPS shares right now up by 5.1%. Rival FedEx also higher today, up now by 1.9%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie. Do appreciate it. Well, as you know, Bloomberg Business Week has for years ranked the top business schools in the U.S. and around the world. And if you never want to miss a Bloomberg Business Week story, become a subscriber today. Or ranking.
Right.
Because you'll unlock deep reporting and analysis from reporters all around the world, including unlimited access to Business Week. Check out our offers right now at Bloomberg.com/subscribe now.
All right, as we shared with you last month, Stanford University once again held down the top spot among full-time MBA programs at U.S. schools, as it has for the past 5 years. Business Week also looks at the top schools around the world. Number 3 in Europe this year is SDA Bocconi. I wanted to make sure I said it correctly. SDA Bocconi.
You can't go there unless you say it right.
That's why I'd like to go there, which ranks ahead of London Business School and INSEAD. We've got with us Stefano Caselli. He is Dean at SDA Bocconi, along with the person who makes it all happen in terms of the MBA rankings. We're talking about Dimitra Kasanides. She's Bloomberg News Senior Editor, both joining us here in our Bloomberg Interactive Brokers studio. Dimitra had a great question, and I'm just going to give you props and credit for you. What brings you to New York City?
Well,
you're a long way from home.
No, it's great. So because in New York, we have a lot of alumni. We have a fantastic chapter. I have a very long traditional relationship with the U.S. market. So many students, after, Bocconi program, decided to move to United States. It's quite important to have alumni for fundraising, for placement. So it's quite important to stay here. So it's, let me say, it's the most important place in the world. So it makes sense to stay here, right?
We're not going to fight you with that.
The most important place in the world.
But there is something about, tell us what makes your business school unique when you
think
about the placement within the world and attracting people from all over.
Let me say is unique for the place in which we stay. So Milano is a unique platform in the European playground. And you have a campus which is fully sustainable, which is one of the reasons why some rankings are flying this moment. And the other aspect is related to the fact that SDA Bocconi is classified as a business school. So for statistics, you mentioned, we are a business school. But every time I pitch SDA Bocconi School of Management, what I pitch is a school and management. Because management is not just simply for business. Management is for all, for any kind of organization, for profit, not for profit, public admin. And today, in a world where geopolitics, connection, and interaction within different industries are becoming more and more relevant, that's, let me say, the side which is most attractive of my school.
I do wonder, Dean, about geographic competition. Because, we classify them as international business schools versus U.S. business schools. And certainly, INSEAD and London Business School are competition to you. But how much competition comes from schools based in the United States given that, especially over the last few years, the U.S. economy has absolutely roared back, whereas Europe's has struggled.
Let me say, competition is great, not because I have to say, but competition is great to raise the bar of every business school. So we raise the bar thanks to competition. Today, let me say what is happening is not just simply competition between European business school and US or within the European playground. Competition today is based on the capability to attract talent, and we have to showcase, you know, what is our unique selling proposition, why it makes sense to say Milano. And the other part of the story is to help students to find the right job. So all the business schools are struggling in, you know, ensuring the best placement today is the key element. And so we have, let me say, to find the right way, the right chemistry to combine talent with placement, with the network in which we stay. And obviously, United schools have, you know, let me say, the competitive advantage to stay in fantastic networks and to stay, you know, in cities that are hubs to attract talent. That's quite important. So this is one of the reasons when I discuss with my friends and competitors in Europe, became a very relevant to network, let me say, in Europe, to work as a hub together, because the students are attracted not only by the brand name of the school, but, you know, by the network, because the network made the placement for the students.
Makes sense. So there's some of that that's going on with U.S. schools too, right? I think you were telling me, I mean, certainly the schools in the U.S. to some degree are competitors, but do you have relationships with several of the schools and programs that you've developed to open up opportunities for your students? Can you speak to that a little bit?
We have a very long story of relationship with the school. I mentioned that Bocconi has 53 agreements of exchange with the top U.S. university and business schools. So basically our students spend a semester in US and we host US students in Bocconi for one semester, which is a great on the two sides, because it's not only for the culture, the career and the content of our students, but also to create a sense of awareness of Bocconi within the US market. And you have also several joint program or double degree with US school. We have a World Bachelor in Business, which is a program we ran together with Marshall at US University of Southern California and Hong Kong University of Science and Technology. So one program, 3 degrees for students. It's a great impact. We have a double degree with Yale, the School of Management. So that's quite important, not only for the reputation of Bocconi, but also to give opportunity to students, because if they have 2 degrees or 3 degrees, they are eligible for 3 different job markets.
Right.
So that's quite important today.
Do you have to do that? Because I do wonder, we've had lots of conversations, right, about demands for MBAs, and we've had stories about maybe students aren't so interested in getting an MBA anymore. What are you seeing in terms of demand for degrees? Talk to us about admissions or people who are applying applications. Has that gone up?
If I consider the European playground, we need to have in mind that basically in Europe we have 2 layers. The layer number 1 is represented by Master of Sciences, and Master of Sciences are super large, so that means a lot of students, a lot of pressure on placement, and MBA represent in a certain sense the jewel of the crown that is on top of Master of Science. Let me say the demand coming from students is not stuck, is growing, because there is an ambition of top students, top talent to enter in a top business school and to find a great job. What is happening is for second-tier business school, I say with a lot of respect, is becoming very tough to stay in the market. It's a market for top business school, but if I consider top business school in Europe, the demand is not stuck, is growing. Obviously became more complex, more challenging for us, because we are, let me say, landing in a world where the placement is really one-to-one, is tailor-made. So if I want to attract talent, I have, let me say, to design the right career path for the talent. So it means a lot of energy.
Well, let's talk about that career path, because here in the U.S., different schools are known for having different specialties, or not specialties, but attracting a student who wants to do a certain thing. Stanford talks about entrepreneurship a lot,
right.
Tech, you know, Silicon Valley,
right.
just a DNA of that there. Here in New York, NYU and Columbia lead to a lot of finance jobs. You go there, and you have at Columbia, you have, the investing program, Graham Dodd, et cetera.
Or hosts of a show called Bloomberg Business Week. But
what are you guys known for? I mean, if you go to Milan, what's the career path that you're known for? What do you attract?
Let me say, if I consider statistics, is just to simplify, but I'm not simplifying, is 1/3, 1/3, 1/3. It's 1/3 is the financial system, which is in the past was investment banking only, and today is a bit more complex because investment banking, asset managers, illiquid investment. We have to remember that in Europe, we have a massive amount of asset that need to be managed. So the presence of asset managers of illiquid fund is there. So they are very attractive, let me say, for students. The other 1/3 is for consulting company and advisory. Let me say is an evergreen, but however, they continuously need the top talent because the demand of their customers is becoming more and more complex. And the other 1/3 is represented by corporates, typically large corporates, and we have some verticals. Let's think about the luxury system. It's quite attractive in Italy and France, and so is not obviously the most important, but if I consider corporate, obviously luxury system is a right combination between Milan, the tradition of, let me say, made in Italy, and the capabilities of Bocconi University. So, and then the mix is evolving within this 1/3, 1/3, and 1/3.
So like the LVMH, like luxury, they're going to the big LVMH, those, I mean.
Kering.
Right,
And
Kering.
obviously, we have giants, but we have to consider that these giants in Europe basically support an ecosystem of SMEs that are jewels. Because if I consider, let me say, a luxury product is the outcome of a process, which is the genius of the design, but it means a lot of quality of SMEs working within the network to sustain. So, and these companies, because they have to be compliant with the quality of the giant of luxury, they really need top students exiting from business school. So, and for us, it is an opportunity.
Dean Caselli, just one last question. Unfortunately, we're running out of time, just about 40 seconds. I am curious, though, are you seeing more students come in from other parts of the world, and in particular the United States? We've heard a lot of, as the cost of education in the U.S. has gone up, that you have U.S. students kind of looking outside the U.S. Are you seeing an increase?
I see an increase.
And just got about 30, 40 seconds.
Typically, if I consider my students, 1/3 come from Europe, France, Germany, 1/3 from Asia, where Asia means India and China, and 1/3 from North America. And the number of students coming from the East Coast is increasing for many reasons. And one of the reasons is the tuition fee, but not only, because thanks to rankings, many European business schools today are very visible, and rankings are a great proxy of the quality of what they can find.
Interesting stuff. Come back soon.
Thank you. Great pleasure.
Thank you.
Thank you. Stefano Caselli, he's the Dean of SDA Bocconi, and of course our Dimitra Kessanidis, Senior Editor at Bloomberg News. Check out all our coverage when it comes to MBA schools and rankings. You can find that at bloomberg.com/businessweek. Thank you both. This is Bloomberg.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got 20 minutes to go ahead of the closing bell. The Dow lower, the S&P, NASDAQ, they are both higher. Tesla is surging. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks are trading mixed right now, with the Dow currently down 131 points. S&Ps are higher by 15, while NASDAQ gains by 0.8%. The U.S. 10-year yield at 4.2%. Gold is higher by 19. Oil is in the red. And Bitcoin, that's higher by 2%. Among the main 11 S&P sectors, leaders were consumer discretionary and real estate. Materials were under pressure. And leaders to the upside in the Dow, Goldman Sachs and Amazon, while IBM fell 6.5% after earnings and led to the downside. Also after earnings, Tesla rose 21%. Newmont Mining plunged 15%. And in deal news, QuickRead is said to make a takeover approach for Summit Materials. Wrapping things up, some of the names pointing after the bell tonight include Western Digital and L3 Harris. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg type squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. About 18 minutes left to go until we close up the markets on this Thursday, October 24th. Ring the closing bell. Charlie, of course, just talking about the numbers. A little bit higher in the S&P 500. NASDAQ 100, outperformance there, and a little bit lower, down about 1/3% on the Dow Jones Industrial Average. Just feels like we're marking time a little bit.
All you got to know about
Got a lot of earnings
the
to
bell
come.
today, Deckers and Skechers.
Do you wear them?
Do not have, so Deckers makes Uggs. I don't have those.
Oh, they do.
Yeah.
Skechers?
I think Deckers does Hoka's too.
All right.
Is that right? So yeah.
We
maybe.
digress.
We digress. Hey, let's drive to the close. We got with us Savesti Balafas, CEO at Goldvest Advisory. It's a boutique wealth advisory firm. It serves high net worth clients. Goldvest has about $600 million in assets under management. You guys also launched this late stage VC fund.
Yes.
We're going to talk about that in just a few minutes, but I want to get an understanding from you about what you're hearing from clients right now, because a lot of people we talk to say there's a lot of kind of stresses out there.
There's stresses out there. There's a lot of election talk. We're less than 2 weeks away from the election. So certainly asking about the election, should I do anything? What should I do?
What are you telling them?
We've got you covered is what I'm telling them. We've done all the things that we were supposed to do already. We've asked about your cash needs. We've diversified your portfolio. We're positioned, whether it's Kamala Harris or Donald Trump that wins, we feel confident about what we have in clients' portfolios. The main thing is about diversification. So we've done that work already. So right now, we're not making any changes that are going to cause any unnecessary tax implications. We're staying the course with our diversified portfolios.
So in other words, you're saying business as usual. So you're not doing, whatever the outcome is, was there some kind of positioning you did ahead of the elections just to kind of put everybody in a certain position? Like, was there some changes you did make, and what were they?
So we did do rebalancing. We have made those changes. We have clients invested. We are doing rebalancing. Market, as you know, was up over 20% last year.
So
up
pulling
over
some out of
20%.
equities because of the run-up.
Exactly. So we're rebalancing back to our target weight positions, but we're not making sudden changes. We are looking to diversify, though, even further. So out of stocks, you mentioned gold is up, stocks are up, Bitcoin is up. All the asset classes seem to be up this year. What we're looking at more so is in private markets, alternative investments. So looking a bit more on the alternative side.
Are you playing in crypto, Bitcoin at all?
No.
Are your clients?
Here or there they talk about it, but no, not really.
Yeah, I'm not surprised to hear you say that.
Yeah.
So private markets,
yes.
Dig a little bit deeper. I feel like we've gone out to milk in a couple of years, and it feels like that's all anybody ever wants to talk about is the private, private markets, and increasingly private credit, not necessarily private equity. So what specifically, what kind of exposure can you give your clients on that front, and what do you do?
Yeah, so We do have access to private credit, but we are more interested a little bit more on the private equity. We did launch a fund recently, but the main point on private equity and private markets that I like to talk about and remind people of is that the opportunity set is broader and wider on the private side. So in the 90s, there was about 8,000 public securities that were available.
I know.
Half of that number exists today. Companies are staying private longer, right? So we have to look at that exposure and diversify there as well. I think that's the big opportunity.
The challenge there, though, is what it does for your clients in terms of cash needs.
Yeah.
You know, this is, and even with your VC fund, this is separate. The privates are separate from your VC fund, right?
Privates are part of the VC fund.
But the VC fund that you're
Late
launching
stage
is
private.
new,
Yes.
whereas the privates
Yes.
you've had given access to for years.
Yeah, we have access to different private markets for years. Yes, this is the late stage venture fund we recently launched is the new fund for us.
In that late stage venture fund, you have a goal of raising around $50 million.
That's
You're going to
exactly
invest in AI, SaaS, fintech,
That's
and the
right.
like. Who are you? How does this work when it comes to like a wealth advisory firm? How do you go out and sort of solicit money for this?
It's a lot of work, and I have a great team behind me that helps me do it. But first, there's on the deal sourcing side. So that's number one, deal sourcing. What companies do we want to look at? So that takes a lot of work, and there's a lot of ways we look at that. And it's a lot of communication, building out our network, and talking to people in the industry and hearing what's going on.
Why is this the right move rather than just investing with venture capitalists? So like you could, as a wealth advisory, you could say, okay, we're going to invest in, you know, X fund from Sequoia or from Andreessen Horowitz. Like you guys could do that.
It's really hard to do that, actually. If you're a $3, $4, $5 million client, to get an allocation that makes sense for your portfolio, it has been hard. Companies like mine are making it easier, but it has been very hard actually to get that access.
You could do a fund of funds.
There's some fund of funds out there. I'd say you don't get the same economics and return potential as a
there's
fund
another
like
layer
ours.
of management.
There's another layer of fees. Yeah,
Okay.
there's fees upon fees. And what I've found is those funds end up getting overly diversified, and you end up getting the illiquidity without enough of the potential return. So our fund is a little bit different in that way. And I think, you know, going back to something that you were asking earlier, illiquidity is a part of this. So if you're investing in this, you have to know your money is locked up. But our clients are investing for the long term. So we've already talked about cash. The clients that may need cash on a monthly basis or over the next 12 months, 18 months, we've taken care of that. This piece is longer term. They're not touching this part of their portfolio. So it absolutely makes sense to look at that broad array of opportunities.
So longer term, 3 to 5 years that they're
3 to
locking
5
up?
years, yeah.
And late stage VC, so is the expectation that it's either a company that goes public or more likely gets sold to somebody else?
M&A, some liquidity event. So it could be going public. It's, you know, there's been obviously
It's
a
not been a
lull.
really- yeah,
There's
a
been a
mega
lull
lull.
in the IPO market. So whether it be an IPO though, which we do see more sites of next year, even some of the companies that reported like Blackstone or KKR talking about that. So I think next year is going to be a bit better. But yeah, so it could be an M&A or IPO event, strategic acquisition.
Savesti, why do this now?
It's a great time for it. As I go back and I talk about diversification, so stocks are hitting all-time highs, tech company stocks hitting all-time highs, all the asset classes are up. This is a good time to diversify a little bit and go into this market. Valuations are suppressed, but I think that's going to turn around. So if we want to buy low and sell high, this is a great time to be looking at these assets.
When you, who do you raise money from for this VC fund? Is it from existing clients and you just allocate some of their capital into it?
Yeah, some existing clients. We work also with other financial advisors. So we do have other financial advisors that use us for their investment management. So they're introducing it to their clients. That's been really exciting for them because clients are asking about it. How do I get access to Reddit before it goes IPO, or a number of the other names before they go IPO? And so we're giving other financial advisors something to talk about with their clients and something interesting to invest.
And I would assume it's accredited investors or
It's
no?
accredited investors and qualified clients.
All right, interesting stuff. Thank you so much. Really appreciate it. Savesti Balafas, she is CEO at Goldvest Advisory. They're a boutique wealth advisory firm serving the high net worth client world. They have about $600 million in assets under management. All right, folks, about 11 minutes to go until we wrap up throughout this trading day.
Coming up next, we're going to be joined by our Bloomberg TV team for our cross-platform coverage. It's on radio, TV, YouTube, and on Bloomberg Originals. We're going to count you down to the close and beyond.
This is Bloomberg Business Week with Carol Messer and Tim Stennebeck on Bloomberg Radio and Television.
It is Bloomberg Business Week. What would you like to hear about on Bloomberg Radio? Help make shows like ours even better by taking our Bloomberg Audience Survey. All you got to do is visit youtube.com/Bloomberg Podcasts. There you'll find our page, and there you can click in our profile or community section to take the survey. It's hosted by our partners at Material. Fill it out now at youtube.com/Bloomberg Podcast. And also thank you to everybody who has filled out that survey already.
Pretty cool stuff. We definitely want to know what you want from us because it really helps us in getting an idea and making sure we're doing the right stuff and focusing on the right stuff.
It's weird.
Like
all the respondents,
earnings.
they say, it just says more Tim and Carol. That's what it says. That's all I hear.
I heard
yeah.
that.
It's
More
just,
Tim and Carol.
I have early access to the results. Okay? That's what,
that sources
more,
say.
more,
You actually
more business week.
talk
yeah.
about polling, right?
Yeah.
This is like spot on, no margin of error, right?
Yeah, these are the only polls I have access to.
They just want us.
Yeah, exactly.
Funny how that works that way. One thing I'm pretty sure you guys want is more earnings. I know if Matt Miller's listening, he wants to hear every little morsel of every earning that crosses the Bloomberg terminal.
He wants to know not just the big ones like Tesla, but he wants to know, even if those numbers cross, he wants to know all the companies that are happening.
So every little anecdote.
Today we got
every
Texas,
little company.
Texas Roadhouse, Dexcom, Capital One, Digital Realty Trust, Deckers Outdoor, and Skechers.
Deckers and Skechers are favorites of Matt Miller. I know he's listening.
So,
he's going to be taking notes. He's going to be talking about it on Open Interest tomorrow because he's going to say, hey, listen, if Carol and Tim talked about it, I got to talk about it.
UGG.
Uggs. I love Uggs.
Hoka's.
Hoka's.
Tevas.
Hey, you know, Tim's really cool, but he actually has a pair of Hoka's.
Anu. I do have a pair of Hoka's.
I've had Anu.
You've had Anu?
They're
So
like-
those
they're like
are
yoga sneakers.
Those are the Deckers brands. So
Yeah.
I have some Hoka's. Skechers. I don't have any Skechers, but they're
I don't
also
have any
reporting.
Skechers. Didn't Taylor Swift do a thing with Skechers like years ago? I think my daughter bought a pair of
No
sneakers.
idea.
I think she did.
You're asking the wrong person. I'm
I
sorry.
am. Just you wait till your little one is a teenage girl. Just you wait.
Oh, giving me anxiety
Fashion
already.
shopping. It's
Hey,
a lot of fun.
Speaking of anxiety, the troubled
Right on
taxi
Skechers.
assets.
Oh, what do we got?
Yeah, have been targeted by a $3 billion credit fund. This is a great story. It's a Bloomberg exclusive. We got a trio of great reporters, Laura Nimes, Katie, Katya Porzikansky, and Natalie Long, writing about how Marblegate Asset Management is in discussions with state regulators about how it can potentially take over the assets of New York City's insolvent taxi insurer. This is according to people with knowledge of the matter.
Yeah, it's a $3 billion investment firm. It's the city's biggest medallion owner and lender, hasn't made a formal proposal, and is one of multiple parties that have reached out to New York's Department of Financial Services about the situation at American Transit Insurance Company, according to People. The city's biggest insurer for taxi and rideshare drivers has been insolvent for decades, and a state audit released last month found ATIC's reserves to be massively deficient in its ability to cover claims. In the second quarter, the firm posted net losses of $700 million.
The department remains prepared to engage on any applications or filings fit for regulatory review, the DFS said in a statement. A spokesman for Marblegate declined to comment, as did a representative for ATIC.
How did it get to have an insolvent portfolio of insurance policies?
Is that a rhetorical question, or are you asking me?
No, I'm just saying, like, how do you get there? I mean, I feel like the New York taxi, this isn't just taxi, but it's a lot of taxi assets. Do you remember, go back how many years when it was considered a sure thing to buy a New York City cab medallion? It was, people were buying several. They were worth like $1 million, and then
there were publicly traded companies that had medallions.
And then enter
Uber and Lyft. Yeah, that's
and the market
exactly what
changed.
happened.
So is this just a case of changing market circumstances, or something else that they need an assist? So I don't know. Yeah, it's an interesting thing, right? Changing times in terms of things that are a sure thing for investing, and then the market dynamics change, or the market environment changes.
Also, real implications for people who take these things.
Yeah.
Like, passengers.
You mean like you and me?
Sometimes.
I guess.
Yeah.
I've been in a yellow cab every once in a while, occasionally.
Sometimes that is the local way to get back from LaGuardia and JFK.
I don't do it a lot.
It's the
in
right
New
way
Jersey,
to do it.
they're like,
I gotta
wait,
tell
we have
you.
to double it,
No.
double the tolls. It's like a whole thing.
So much faster.
Which is why I do
So
what
much
I do.
faster.
All right, guys, don't go anywhere. We're heading over to our TV colleagues, counting you down to the close. The closing bell starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu, taking you through the Closing Bell, a global simulcast. It starts right now. Carol Masser in the radio booth alongside Tim Stenovic, as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Carol Masser.
Hi.
Great to see you back here.
Thank you.
But I need you to look at the market and focus for a second here. What's going on?
Can't promise you anything. No, I will focus. I think what's interesting is to see the first gain on the S&P 500 this week, in a week where we've seen a different tone. We're still early in on earnings. We've got a lot coming after the closing bell. I'm thinking about next week when we get some of the big cap tech names and whether or not what that means for market direction.
Okay, speaking of those large cap, the mega cap tech companies, I guess you could say, the Mag 7 hitting a 3-month high. Thank you, Tesla, for those results yesterday, sending Mag 7 higher.
It's amazing.
Up more than 20%. I don't want to give Carol's gainers away, but up more than 20%.
Yeah, it's
not just that though. Tesla's point contribution to the S&P 500 accounts for all of its gains. So you take Tesla out of the equation, and the S&P 500 would be flat right now. There's a lot that's been made, Romaine, about how there's $6.5 trillion sitting in money market accounts. Maybe one reason why people aren't putting that money to work is because they see lofty valuations and they kind of want to wait for a better entry point.
Yeah, it's kind of interesting though too. I mean, the move on Tesla, when we talk about about the idea of valuations and the idea that you had a stock that was beaten down, and then of course you get this surprise report, a surprise for a lot of folks, and of course that's what leads to a 20% pop here. So I still feel like if people are looking for value, I mean, you could make an argument about whether Tesla's value or not, but certainly on a relative basis to Tesla's previous valuations, certainly a value stock, at least for today. I think Carol might get to that a little bit later, but we wanted to help her out with the gainers here.
Thank you.
Absolutely. We're nothing if not helpful. The Dow Jones Industrial Average sitting this rally out, going to close down roughly about 140 points, or roughly about 0.3% as BMO and BlackRock are ringing the bell at the NASDAQ and at the NYSE. The S&P 500, though, that is going to close higher, back above 5,800, a 12-point gain, or 0.2%. The NASDAQ Composite up about 0.8%, and the Russell 2000 squeezing in on the action as well, up 0.2%.
Just a little bit of a gain there. Hey guys, almost an even split here in the S&P 500. 249 names to the upside, 252 to the downside, 2 unchanged. Scarlett.
Yeah, pretty much an even split too when you look at the sector performances in the S&P 500. Materials are your worst performers. Newmont, the big drag there, that group down by 1.4%. Utilities and industrials each losing 0.7%. And consumer discretionary, which is really on the back of Tesla, is up 3.25%. Communication services and REITs are each up by about 0.25%.
All right, a lot of green on that map. We've talked about Tesla a lot already. Romain giving me, I should say, an assist earlier too, in terms of why we saw this one heading higher, finishing just off its highs of the day, up 22%, biggest one-day gain since May of 2013, top in the NASDAQ 100, a top gainer in the S&P 500. We know strong earnings we got from the automaker. Auto profit margins were also strong. The forecast of as much as 30% growth in vehicle sales next year. Elon putting that out on the call with analysts. You got to keep in mind, some analysts were out there, as you said, Romain, low expectations going into this quarter. So anything that was good news, even slightly good, and then if it's even stronger, there were a lot of excitement over what it got. The stock.
Hey, this is going to be fun, Carol Master. Pop quiz. Remember when I used to do these on you all the time?
No.
You said Tesla was the #1 gainer in the NASDAQ 100. Do you know the #1 gainer in the NASDAQ Composite today?
It's not Tesla, is it?
No, it's not.
I don't know.
Is it a pharmaceutical company?
Yes, it's a pharmaceutical company.
I could cheat, but I'm not
always
cheat.
go there with the biggest movers in the
biggest movers. Up 600%, Carol Master.
Who
you
is
failed
it?
today's pop quiz. Monopar. You know them.
How did I miss that one? Now I feel like my gainers are not as exciting.
All right, what do you got next?
Hey, I just want to say, though, Tesla is...
Welcome back, Carol.
I know, exactly. Tesla is still off 40% from its high back in November 2021, so a little perspective. UPS, another one, up more than 5%.
This was surprising to me, right?
Yeah. Well, and was up 10% at its highs, finishing the day with about a gain of about half of as much, 5% higher. It returned to sales and profit growth for the first time in nearly 2 years, driven by higher volumes, more profitable packages, and steadying labor costs. Yeah, I mean, they really seem to deliver. What?
But then we had Jonathan Chappell, analyst over at Evercore, on earlier today. He was kind of poo-pooing it a little bit. I mean, he kind of gave Carol Tomei a pat on the back, but was kind of like, look, this is one quarter, and they got some other issues that go well beyond what just happened in 3Q.
Let's not forget, back in January, they were planning to save $1 billion in costs, and they're cutting, some 12,000 management jobs. So there's been a lot going on at that company. And then we got some earnings, a place I think that you like to eat.
Texas Roadhouse. I don't know if I'm allowed to say this, but I used to go here actually a lot. I have one like right across the street from our office. I used to go all the time. Unfortunately, they're not doing that well, at least not in the most recent quarter. EPS looks like a miss in the most recent quarter. $1.26 on an adjusted basis. Street was looking for $1.33. Revenue coming in line with estimates at about $1.3 billion. They're just going to round that up. But the company also saying that it sees commodity cost inflation below 1%, and that's a revision lower. Previously had seen 2% here, so a potential benefit, if you will, long term with regards to its own commodity costs. So the shares you see down about 6%.
Yeah, taking a look at the press release right now, the company said that they, compared to the prior year, results for the 13-week comp restaurant sales increased 8.5%. At company restaurants, increased 7.2%. At a franchise restaurant, average weekly sales were $149,000, of which $19,000 were go-to sales.
But it's in the full service restaurant space, which a lot of people are down. They're leaving that behind and going to the quick service restaurant, or they're moving up from fast food to quick service restaurant. So it's kind of like they're not in that sweet spot just quite yet. Let me just jump in here with Dexcom results. Third quarter revenue meeting analyst estimates $994.2 million. Analysts were looking for just a little bit below that. But you have a big drop in the after hours trading here of almost 12%. In terms of the full year revenue, remain $4 billion to $4.05 billion, pretty much in line with what analysts were looking for. They were anticipating $4.01 billion.
Well, it's interesting too, and it's interesting to see the share reaction. And we're also keeping an eye on Edward Life Sciences. We were just talking with Sarah Malik over at Nuveen, who's actually had this on her radar. She's relatively positive on it, but it'll be interesting to see whether that competing medical device company actually has the same reaction as we're seeing right now in Dexcom.
15% to the downside.
Yeah, I mean, listen, this is one that's already down 40% so far this year, so getting hammered a little bit more, certainly in the aftermarket. All right, guys, let's get to another one that is crossing in the aftermarket. We're talking about Capital One Financial. Let me walk you through the numbers. All right, third quarter net interest margin, 7.11%. That's above the estimate of 6.91%. Net revenue, $10 billion, also a beat. The estimate on the street was $9.87 billion. Third quarter total deposits, that too is coming in higher than forecast by the analyst community, $353.63 billion. The estimate on the street, $345.43 billion. Third quarter adjusted EPS, $4.51. Quite a beat. So 451 versus an estimate of 377. What do you got?
Tapestry.
Yeah.
We're now getting this crossing the Bloomberg terminal that Tapestry deal with Capri has now been blocked by a judge. The FTC, of course, had challenged this merger. We are now learning. We don't have a lot of details other than that right now, guys. But that Tapestry deal that, of course, a lot of folks thought would not make it through the regulatory process, Scarlett, has been blocked by a judge in a win for the FTC.
And I'm just going to point out, Tapestry shares are up about 6% here in the aftermarket, so investors reacting pretty quickly.
And this is a rare win for the FTC as well, because they've blocked a lot of these M&A deals, or at least, kind of stood in the way of them. But once they got to court, it didn't actually necessarily pan out. Again, the Tapestry deal with Capri is blocked, and this was part of their effort to create a U.S. luxury giant to better compete against Kering and LVMH.
And I am curious, though, to see how, and holy cow, can we put up Capri shares, by the way, very quickly here? They're actually down 51% here, if my numbers are correct on the screen. Someone please double check me here. But right now, trading below $20 per share here in the after hours trade.
Right.
And I think that really says it all. To get to your point, Carol, the idea that you saw Tapestry shares move higher and that you're seeing this big drop off in Capri, I think you really understand where investors' heads were at as to who this merger was much more important for, Capri or Tapestry.
That's remarkable. Shares down 52% as a result of this ruling. That's pretty remarkable to see.
Right.
Go ahead, Carol.
But it speaks to, right, like what we've seen, that in some ways building these, I don't want to say conglomerates, but pulling in more brands to certainly a company can be beneficial. And certainly Tapestry saw it that way, and certainly investors necessarily saw it that way.
And I am curious, and I'm just going to play devil's advocate for a second, because we kind of saw this with the whole JetBlue and Spirit Airlines deal. You have companies that are clearly going through issues, and maybe M&A is the solution to those issues. But when you have a regulatory environment that basically says, we can't allow this, then what is the future of a Capri? What is the future of a Spirit Airlines if they don't have that optionality for M&A and other strategic options?
And the other thing I would say is throw in globalization, or when there is global competition, that sometimes you need to have bigger players. I'm not saying that, you need to think about the impact on consumers and competition, but you do wonder about that going forward.
Does this make them more ripe targets for activist investors or private equity?
Good point.
But I also wonder about the consumer protection here. Like, what's the argument for not allowing a deal like this? I'm interested to hear that. Like, who are they protecting? What are they protecting?
Well, I'll say Lena Khan is more than welcome to come in the show and explain that.
Yeah, I think that'd probably be pretty interesting. Capri shares sinking by 54% after Tapestry deal blocked by judge.
Speaking of fashion.
Yeah, we're getting more
Thanks
and more.
for moving them along.
Okay, let's look at Skechers. Skechers shares are higher by close to 10% in the after hours right now. The company announced third quarter results, record-breaking quarterly sales. Taking a look at the company results, third quarter earnings per share coming in above estimates at $1.26 per share, beating estimates of 93 cents. The company also said it sees fiscal year sales at $8.93 billion to $8.98 billion.
Yeah.
So narrowing its forecast to the higher side because
All right,
it's 8.88 to 8.9.
All right, so Skechers doing well, up 10%. Deckers, which of course makes Uggs, also doing well, up at 7% in the after hours trade. I'm just going to get right to the forecast, but the company is saying for the full year, EPS will come in at $5.15 to $5.25 per share. And I'm going to wait to give you a comparison on that. I think we have some wrong numbers here. But 2Q net sales also coming in above estimates here. You see the reaction in the shares positive to the upside.
I'm thinking Tim's an Uggs guy, and maybe Romain, you're a Skechers guy.
Hoka's.
No?
Yeah, Hoka's. I know Tim.
You guys like
Tim's
those big sneakers?
Why not?
No,
I've never seen it.
You know, you only live once.
No, I don't.
It's like they're like a foam weapon. They're so big.
It's Gucci loafers all the way.
Oh, Gucci. That
I mean, it's a little hard on the treadmill, but you know, I tough it out.
Oh,
Sacrifice for fashion.
All right, guys, lots of stocks moving in the aftermarket. We got to run. That's our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We will see you again, same time, same place tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
It is Bloomberg Business Week. How about that for earnings, Carol?
That was a lot.
Yeah, that was a
That was
lot.
all for Matt, because Matt Miller wants to know every tiny morsel of
there's
earnings
more.
that cross.
I'll tell you. Bloomberg Terminal.
And what's the
Get
granular
the numbers
data?
right away.
Yes,
okay?
indeed.
So that's all you need.
Pretty cool stuff.
You need that and us. That's what you need.
Yeah, that survey, more Tim, more Carol.
Yeah, exactly. Hey, I want to talk
And
a
more
little bit.
Ian King.
I want to talk a little bit about what we're going to talk about with Ian King right now, because Jensen Huang over at NVIDIA struck a partnership with Asia's richest man, Mukesh Ambani, to build out AI infrastructure and spur the tech's adoption in the world's most populous country. Ambani's Reliance Industries in India is set to use the latest Blackwell chips from NVIDIA. NVIDIA also forging partnerships with Indian conglomerates, including Infosys and Tata Consultancy Services. We got with us Ian King, Bloomberg News U.S. semiconductor and networking reporter. He joins us from our San Francisco bureau. Ian, always a treat to have you with us. How big of a deal are these partnerships for NVIDIA? I mean, is this a company that already has embedded relationships with some of the biggest companies in India?
I mean, I think the way to look at this is part of Jensen's world tour. I think Oasis could learn a thing or two from this guy on how to get around the world.
What's harder? Ian, what's harder to get, Oasis tickets or a Blackwell show?
Blackwell,
okay.
Worth way more as well.
Worth more, okay.
Yeah, I mean, it's important to point out India as an end market is just not there for NVIDIA right now. Clearly, it's still very much developing. Everybody knows about the population. It's, that's clearly the promise for the future. But at the moment, it's just in the others column for NVIDIA as an end market. But what Jensen is doing, and he's going to Japan next. He's been in Denmark recently. He's been, as you know, he's been everywhere. Is basically trying to embed his technology within the national infrastructure, the local business leaders of pretty much every country he can, that'll let him through through passport control. And this is another example of it.
I think when you're Jensen, you have like your own passport control. They come on the plane and stamp your passport there. Ian, why is he doing this though? It's NVIDIA. They're the only game in town. There's no other option for technology like this right now. Why does he have to sell it? Aren't people knocking down the doors getting to him?
That is an excellent question, and if you were to ask him that, I think you would start to see veins appearing on his forehead, because that is not the way this man runs this company. 30 years of running this company as the underdog, as the company that was always going to get squashed by Intel. He knows what opportunity looks like, and he knows that it can be fleeting. So he's doing everything he possibly can to spread his technology as widely as possible and get it embedded in everybody's uses, because guess what? Biggest customers are trying to do their own thing. Everybody else is looking at this market and running to catch up. So, he knows that he has to take advantage of that. And it's to his credit, whether he's going to be successful or not, who knows, right? But it's to his credit that he doesn't see this as a victory lap, but sees this as just an opportunity which he has to grab with both hands.
I guess I also wonder when I read this story, Ian, is it a case of where data centers already are and exist for a lot of American companies or operations or back office operations? We know there's a lot of call centers and stuff. And I just wonder, are they going to continue as they ramp up their use of AI, that it makes sense for these investments to be done in India? And Jensen is smart to do this.
I mean, there are a number of layers to that, and you're asking the right question there. He's putting infrastructure there where possibly they can't afford it, where it might not be deployed as quickly as he would like. So he's like, hey, we can help you out here. So there's an element of that going on. Future-proofing a very large percentage of the world's population and dragging them into the AI, the digital economy, that's got to help too. Got to bear in mind a very large percentage of the world's population in China is having restricted access to his technology, so he's covering his bets there, and also Hindi, right? Right now we're getting large language models that work very well for English, but guess what? There's a lot of people who speak Hindi. That's a big push of what's going on as well.
That's a really good point. Ian, the idea of on-premise versus in the cloud is something that I've been thinking a lot about. I know, Carol, you've done some panels over the last year talking about this. Why is it important for Jensen and NVIDIA to sell directly to some of these companies versus these companies just using AWS or Microsoft Azure to do what it needs NVIDIA chips to do?
I mean, the simple and most cynical reason is that Microsoft, AWS, and all the rest of them, huge buyers of NVIDIA chips right now, but they are working really hard not to be doing that and to build their own chips. So future-proof yourself there by finding other customers. The flip side of it as well is there's also data sovereignty, right? A lot of the world's governments are not happy with these national treasure resources, which is data, floating around the world and being sort of stored and used elsewhere, that they want to keep that sort of in-house, and Jensen is pushing that idea very hard. So that makes sense as a sales tactic and also a proliferation mechanism as well.
Is there any issue when it comes to the U.S. government and the view that it has about other countries using this technology? I mean, we talk to you all the time about China, but where else are red flags raised on this world tour?
Right. I mean, there's a lot of money being spent in the Middle East, as we know that those nations want to use their big piggy banks to try to buy their way into this modern digital economy and be less reliant on petrochemicals. But as we've seen, Washington is taking a kind of a very slightly jaundiced, cynical, however you want to describe it, view of the implications of that and weighing potential limitations on that. So again, Jensen is looking at that and saying, okay, well, who else? Let's future-proof ourselves. Japan is the next step, right? Japan is a U.S. ally. Japan is home to U.S. armed forces. Let's go to Japan. Let's make sure they're buying our stuff as well. So, you know, he's being very, very active in sort of making sure that every opportunity is taken here.
All right. So you're the smart one here on this. Sorry, Tim.
That's okay.
No, but Tim is too. So when you read this story, I don't know, how do you kind of roll it into everything else that you cover on the semiconductor world and NVIDIA? Like, what do we need to kind of take away from it?
Yeah, the takeaway is, my takeaway was when he stops doing this kind of thing, I would be concerned, or maybe that's a sign that he's already done all he needs to do, and NVIDIA truly has taken over the world. That's what's going on here. But this is, I think, just get a sense of like a company that's got to the top and they're not getting happy, fat, and lazy, I think would be the takeaway that most people should take from this.
They're not getting happy, fat, and lazy, but look, you're not here to advise Jensen. We're not here to look into his head. But what you did say, Ian, gives us a good idea of how NVIDIA got to where it is today by really worrying that Intel is going to come eat its lunch. That's obviously not going to happen. When can this guy relax a little bit?
I don't think that's in his nature. He was interviewed about this recently, and he's like, the next 10 years is going to be the most exciting. And I think the interviewer was like, well, you're kind of 61 years old. Where does this passion come from? And, you know, he was very honest and very reflective that that's just not his nature, right? That he wants to, whatever he does, he wants to be the best, and he remembers all of the mistakes and carries with him all of the wrong turns, and that's kind of what drives him. As long as that continues to be the case, then that's probably the kind of leadership you want in such a fast-moving industry as this.
I guess that's why I'm not running NVIDIA, Carol, because I'd be like, yeah, okay, well, I'll go to this island. Chill here, maybe do some
sell some shares.
Yeah.
Enjoy
the fruits of my labor a little bit, you know? But hey, I'm no Jensen Huang.
Different creatures. And I think it's really interesting what you said, that, you know, he's known, right now he is sitting so high at the top here, but he remembers when that wasn't the case, right?
Yeah, and it wasn't too long ago, right? Remember 2022, Intel had way more revenue than Jensen did. This year, he's going to have multiples of what they have. So this is a very, very recent thing for him, and he's absolutely cognizant of that.
All right, cool stuff as always. Ian, thank you so much. We really wanted to talk about this, so thank you for jumping on with us. Ian King, U.S. Semiconductor and Networking Reporter here at Bloomberg News, joining us from our San Francisco bureau.
Hey, we got a little bit of breaking news crossing the Bloomberg terminal. Morgan Stanley said that CEO Ted Pick was elected to the board to the additional position of chairman effective January 1st. James Gorman is going to step down as chairman and leave the board. Gorman will also retire from employment at Morgan Stanley and be named chairman emeritus at the time.
To be fair, orderly transition. We've known this was all coming, so it's something, but just
he's
kind
got another transition to work on.
Yeah, well, he's a part of the Disney,
exactly.
right? Transition and stuff.
And, you know, we heard that news just in the last few days, too. So he's got some other, I wouldn't say shoes to fill, but he's got to figure out who's going to be the post-Bob Iger leader there.
Right, in post-financial crisis when they were often separating CEO and chairman, but now you often are now seeing the CEO, certainly of financial firms, become the chairman as well. So again, Morgan Stanley saying indeed that the company CEO, Ted Pick, being elected to the additional position of chairman, that is effective January 1st. All right, folks, you are listening and watching Bloomberg Business Week right here on radio, on YouTube, and, of course, Bloomberg Originals. We do want to head back to Washington, D.C. The 2024 fall meetings of the World Bank and the IMF are underway, and it's where we find Bloomberg TV surveillance co-host Lisa Abramowitz, who's been sitting down having some really deep conversation. And right now, speaking of the big banks and financial global banks, she is sitting down with the CEO of UBS. Let's head to Washington, D.C.
Hey, Scarlett, I have to say, moving from affordable luxury and comfortable shoes to the state of banking in the world. And really, honestly, this is a fascinating moment of change and, frankly, changing global order. Sergio Armati, someone who I am so excited to speak with, in part because you wrote a Financial Times article that I thought was really interesting. You talked about the importance of protecting against protectionism, how it could create a real antithetical environment for innovation, for some of the potential possibilities that you could see coming out of companies. You mentioned UniCredit possibly taking over Commerce Bank. How much does that really stymie innovation to not allow that type of deal?
Well, first of all, I have to say that the article was meant to address, while recognizing that maybe short-term protectionism may sound good, it creates a lot of collateral damages, and particularly when you go beyond goods and services, you look at how capital can move across different jurisdictions in a way that can create value and can help address many of the topics that are affecting our economies and our societies, then you start to see really the cost. So in a sense, that's the first issue. So capital is somehow affected by this protectionism moves. But when you add on regulatory potential arbitrage, and that may or may not be a consequence of protectionism or is another form of protectionism, then you easily go into the debate of how to protect your financial markets, your local players, and then the issue of allowing or not allowing mergers between banks, not only in Europe but across the globe, becomes an issue.
It's amazing. We're talking about affordable luxury handbags in the United States, but there's a similar regulatory crackdown on the tie-ups of banks as well, and we're seeing it on both sides of the Atlantic. But what is the consequence for the banking system? Is it going to be less capital? Is it going to be banks that don't perform as well? Is it going to be higher borrowing costs? What is the consequence of there not being a greater level of merging within the Euro region?
Well, first of all, when you look at even in the U.S., you have a lot of overcapacity. If I remember correctly, you have around 5,000 banks. When you look at Europe, the market is very fragmented. There is scope for creating economy of scale, diversification, and the ability through diversification then to deploy more resources to clients. The cost of that, at the end of the day, the cost is paid by the economy, by clients. I think, of course, shareholders are suffering, but eventually cost of borrowing and the facility and the easiness of accessing credit is impaired. So allowing capital to freely move across jurisdictions creates less cost for the economy.
Is there a warning from the Credit Suisse saga You've benefited from it on the other side. Your assets have increased. You've delivered earnings that outperformed expectations. There is a sense that banks that seem okay are suddenly not okay in a very fast money world. Do you worry that that's the case elsewhere?
No, I don't worry, because if you look at the Credit Suisse situation, was a very idiosyncratic topic that developed over the years. The business model was not sustainable. They didn't really have a great governance, and they benefited for too long from regulatory concession that should not have been granted, or at least not for so long. And that was a quite unique situation. If you look at what happened back in March 2023, banks, large banks, were actually safe haven, were part of the solution, in a sense, in the US, but also with UBS in Europe. So big banks were solid, and it showed that well-designed regulators can avoid the repeat of the financial crisis. But if you go too far, then you create costs, not only for shareholders, again, also for clients. When it's going to cost more to borrow, it's going to slow down investments, and so that's not the ideal situation. There's
a saying, and it's not mine, so you can't blame me or credit me, but that the United States innovates and that Europe regulates, and that seems to be the way and the path of travel, and it's the reason why a lot of people expect the U.S. to grow really significantly and less so in Europe. How much do you see that bifurcation continue with investor flows?
Don't worry, I'm not going to disagree on that. So,
okay.
It's quite clear. You saw it in the last 20 years. Numbers talks clearly, and the underlying trends seems to go still in the same direction. There is a desire in Europe to change path. You saw with the Draghi report, with a lot of very comprehensive report analyzing the state of Europe, with a lot of ideas that, unfortunately, are going to be quite difficult to implement. The reason is that you need 27 countries with quite different interests to agree on a common goal that may result in some of them losing short term for the benefits of the long-term benefit. And in this environment, it's very difficult to get voters to support any sacrifice. And so it's likely that you're going to continue to see the U.S. outperforming Europe, and particularly also maybe other parts of the world.
There's a tension right now that the U.S. election could potentially cause a lot of changes depending on who wins. And there's this fear that maybe people are not going to want to invest in the U.S. bond market as much because of some potential policies, and may want even more to invest in the stock market. Do you see that with your clients in any way, shape, or form? Do you see them preparing for the potential for some really big moves?
I think clients are preparing, through diversification for discontinuity in the market. But, it's fair to say that when you look at governments and central banks, it's quite clear that they are diversifying away from the dollar. And one of the clear areas where you see this happening is when you look at gold prices up this year significantly. It's a sign that there is probably much more than just private investors or institutional investors buying gold. It's probably also central banks in different countries diversifying away from the dollar.
Is UBS buying more gold?
Well, we have plenty of gold. So
yeah, you've been stockpiling it. I do wonder, though, whether people in general are hoping that the ECB is going to cut rates much more aggressively than in the United States and the Federal Reserve, and are hopeful that actually that could be a tailwind in a real way.
That could happen, but remember that while it's fair to say that central banks did a pretty good job in achieving their goals to have a soft landing and managing high inflations without taking down inflations without creating a recessions, the stickiness also in the U.S. of the inflation is still there. So inflation is still above the target rates, and particularly when you look at core inflation. So it's a little bit early to predict that central banks can really go fast in taking down rates without creating a potential collateral damage. In this environment where geopolitics can create discontinuity in supply chains, in energy supplies, it's very dangerous to go too fast and then having to basically retreat, and that at this stage it would be very bad to see rates coming back because actions have been taken too aggressively on the rates front.
Sergio Armati, thank you so much for your time. Sergio Armati there, the CEO of UBS Group. Back to you.
All right, thank you so much. That was Lisa Abramowitz sitting down with UBS CEO Sergio Armati over at IMF headquarters in Washington, D.C. We got some news that we want to continue on. Morgan Stanley saying that CEO Ted Pick was elected to the additional position of chairman, that effective January 1st. Also, some James Gorman news. He's going to step down, Carol, as chairman and leave the board.
Yeah, he'll be named chair emeritus. And we know, succession planning, this is what happens on Wall Street. We know Morgan Stanley has certainly been doing this over the last year or so. But let's get to it. What you need to know. Bloomberg News global finance correspondent Sonali Basak. She's also co-host of Open Interest on Bloomberg Television, so check that out as well. Joining us on the phone in New York City. Sonali, can I ask you what's significant here? Because to me, it sounds like normal news, normal succession.
It's very funny you asked that, because the first thing I thought was that change waits for nobody. It feels fast to me. I mean, when I had first heard of the news last year when they announced the CEO succession, one of my first questions to James Gorman was, when are you going to step down completely from the board, from the chairman position? When will Ted take it on? And they basically said after a certain amount of time where, the transition is really complete, that they would kind of, he would stick around for a while kind of as a senior statesman there as chairman. But you have to think how quickly Ted Pick had made his mark. At the beginning of this year, there were a lot of questions on whether Ted Pick could take over so quickly and as significantly as James Gorman has led that bank. That was a question in the market. It was a question. It was a show me story for investors. But the most recent earnings, they really blew it out of the water. Mm-hmm. And they blew it out of the water so much so that Morgan Stanley stock ended up that same week trading at a better multiple than even JP Morgan had in a price to book perspective. And so this is a significant sign of confidence that this is Ted to run and to own. And James, of course, as you know, has his own set of challenges now because he is really the man leading the search at Disney's board for Bob Iger's successor. So it's a new page, really, for both of these men. Normally, I would say, okay, it's a move on the board, no big deal. But given James Gorman's mark he made on Morgan Stanley and given the elevation of Ted Pick and how well the bank has been doing, it's just another kind of chapter in this page, in this book here.
And to that, in terms of Morgan Stanley, when they reported mid-October, as you said, 32% profit surge for the third quarter, setting shares up the most in almost 4 years. So it really was, as you mentioned, Sonali, a blowout quarter, Tim. And as she said, it kind of showed, hey, I got this. If I'm Ted Pick, I'm like, I got this.
Okay, well, also, if you're James Gorman, you got this when it comes to Disney because he picked Ted Pick to run Morgan Stanley. How's he as chair of the board at Disney when they name a new CEO in early 2026, Sonali? How does what happened over at Morgan Stanley give us a preview of how succession planning will go for the next Bob Iger?
Well, it's very interesting. Obviously, besides that they're in completely different industries here, there are also two different firms. You have to remember, I'm sure everyone remembers really, how botched the last succession plan went. At Disney, Bob Iger had to come back.
But Bob Iger picked that too, right? He was. Yeah. So that's what's interesting also.
So one thing that's interesting, just for a little kind of color in terms of how this happened at Morgan Stanley, Morgan Stanley for maybe a decade had many, many, many candidates where a lot of people were groomed to that very top spot. And it really took until kind of that final year to really choose Ted out of a pool of a small group of candidates. But all of the candidates were very homegrown and knew each business intimately. It's interesting, there's just an irony about this news being talked about right after the Sergio Armati interview. One of those candidates was Colm Kelleher, who is now the chairman over at UBS, actually, so went to a big rival. So for Disney, you know, the question is, they gave this obviously a lot of time and a lot of telegraphing, which is also what happened, by the way, at Morgan Stanley, where, you know, they're saying that James will really take over this effort next year on the board and that they will find this successor into 2026. So they're giving investors years to hang their hat on this search and really start to telegraph what the qualities are, find a range of candidates, and figure out how they can kind of keep that culture of Disney alive without, you know, the most famous man at the helm.
But it does feel very orderly. If I'm looking at shares of Morgan Stanley here in the aftermarket, just fractionally higher, 0.08%. So, right, investors definitely taking it in stride. Hey, good stuff. We so appreciate it. Sonali Basak, Bloomberg News global finance correspondent and co-host of Open Interest on Bloomberg TV.
And?
Did I miss something?
Co-host of Bloomberg Crypto.
I forgot. She, like
Tuesdays
you, wear many hats.
at noon.
Wear many hats. All right, folks, keeping a watch on that. Also keeping a watch on Tapestry and Capri because a judge blocked the planned $8.5 billion acquisition by Tapestry of rival Capri Holdings.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. A number of after-hours developing stories. Earnings just breaking right now out of Capital One Financial, the bank that is seeking to acquire rival Discover Financial Services. Now, it posted a profit that beat Wall Street estimates on strength in its credit card and auto lending businesses. After hours, COF Capital One Financial shares are up by roughly 3.3%. As we have been reporting, Morgan Stanley CEO Ted Pick will become chairman of the board in January, replacing his predecessor, James Gorman. You recall that back in May, Gorman had said that he would step down at the end of the year, and Pick was expected to replace him in that role. After hours, a judge blocked the planned $8.5 billion acquisition by Tapestry, the maker of Coach and Kate Spade handbags, of rival Capri Holdings. Capri, after hours, plunging now by 51%. After hours, Tapestry up by 11.5%. The Dow fell 140 points today, down 0.3%. S&P 500 index up 12, up 0.2%. Nasdaq up 138, up by 0.8%. 10-year 4.20%. The 2-year 4.07%. Gold up $20 the ounce, up by about 0.7%. West Texas Intermediate crude today down 0.5%, 70.41 a barrel. The U.S. presidential election now under 2 weeks ago. Savasti Balafas is the CEO at Goldvest Advisory, and right here on Bloomberg Business Week, she was asked if she's making any changes ahead of the election.
Whether it's Kamala Harris or Donald Trump that wins, we feel confident about what we have in clients' portfolios. The main thing is about diversification. So we've done that work already. So right now, we're not making any changes that are going to cause any unnecessary tax implications. We're staying the course with our diversified portfolios.
Savasti Balafas, the CEO at Goldvest Advisory. Again, recapping, S&P up 12 today, a gain of 0.2%. The 10-year, 4.20%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie Pellet. Do appreciate it. A lot happening in the after hours. We got Charlie Pellet all over it.
Super busy.
Yeah.
Okay.
Okay, get this, Carol.
Okay.
In the U.S., more than 22.6 million people work in healthcare.
A lot.
It's about 14% of the U.S. working population. This is according to the Bureau of Labor Statistics. Yeah, healthcare, pretty huge. There's a ton of money there, and there are a lot of inefficiencies.
We hear about that.
You ever tried to go get an MRI, like, sent from one healthcare provider to another?
It's like impossible.
Yeah, you got to get CD-ROM. Seriously?
I'm like, wait,
Yeah.
do they still make these?
Don't even get me started on faxes, because, yeah, doctors are still doing that, too.
I know.
Well, Anterior is trying to make the system more efficient. It's an AI company. It's focused on healthcare administration. It's backed by NEA, Sequoia Capital, and more. We've got with us Dr. Abdel Mahmoud, CEO of Anterior. He joins us from London. Dr. Mahmoud, good to have you with us this afternoon, this evening. Thanks for staying up late. Where in sort of the chain of the healthcare ecosystem do you fit?
Yeah, well, lovely to meet you, and thank you for having me on. So we kind of the main area is administration. So we were born to tackle the $1 trillion that I think the US spends on healthcare administration every single year. And administration is made up of many, many workflows. But at the core of it, and I think you mentioned this statistic, there's a lot of manual labor. There's a lot of very manual, tedious things involving faxes. And yes, that's true. Doctors still use faxes today. So we've started mainly on the health insurance because we feel like a lot of that administrative workflows and burden starts from that side, and we focus there. And maybe the easy way to say it is we're focused on wherever there's a fax machine that a kind of a highly trained nurse or a doctor needs to spend hours reading. That's the bit that we make faster.
Okay, so I feel like folks have been trying to figure out how to modernize healthcare records and then also protect patient privacy. So tell us about how you guys are going to actually figure this one out. Why you versus everybody else who's been talking about it and trying it, why you can do this.
Yes, that's a great question. And I think you touched on something important there, which is patient privacy and interoperability, right? And the reason we have fax today is actually because it's one of the most secure forms of getting two systems that don't know each other or kind of aren't connected electronically to be able to communicate in a very safe way. The resultant issue of that is that when you send over a fax, the system on the other side receives the fax, but it can't ingest the data, right? It's 400 pages of medical information that only a human today can read. So you hire a doctor or a nurse to just read it. And I think the bit that's made us stand out in the market, and we have the leading product in the market that can be able to understand unstructured medical data and almost like recreate the structured version of that and do interesting things with that downstream, such as prior authorizations, payment integrity, and a few other certain workflows. And that's the bit that's the most valuable here is you can maintain if you still use fax, and we should be getting rid of fax, but it remains a kind of a core part of the US healthcare system. It allows you to then kind of still have that digitized and still have that interoperable so that, our most valuable assets and resources, nurses, doctors, pharmacists, are not spending hours reviewing faxes.
Is this for the US healthcare system only?
Yes, I think the US healthcare system is quite unique in the sense that it spends so much on these administrative workflows that are quite outdated in a sense.
Yeah.
So, yeah.
So where were you in your medical school journey or in your career where you discovered that the US has these inefficiencies? Take us to that moment.
Yeah, so I trained in the UK, and somewhere along the journey, I realized that the impact you can have in healthcare is probably less about how better I got as a doctor clinically, but more about the environment and ecosystem and the tools that we use as clinicians. So I embarked on a master's degree in computer science and spent some time actually at Facebook and then later at Google working on some healthcare applications, and that's where I got exposed. As you know, those are American companies. I got exposed to the US healthcare system, and I saw that. Yes, there are issues of this in Europe and there are issues in Canada and other places, but in the US, it's really magnified and it's blown up in the last 10 years or so. And that's what got me exposed, and that's when some of the large language model stuff and generative AI that was coming out felt like that was the most exciting thing you could apply large language models to, which is this huge problem of unstructured data that, guess what? Large language models inherently have that capability that we never had before of structuring unstructured data.
Oh, Carol, go ahead, Carol.
Well, it's interesting. I do think about AI and large language models and how they might be able to look at an X-ray, and compare it to all these others, in a database and maybe figure out when there really is something wrong and do it rather quickly versus waiting for humans, or maybe there's a doctor who's tired and it doesn't come out so well. Having said that, I'm reading from the Sequoia website, says that what you guys are doing handles all the work that comes before the clinical decision making, where it might take, bless you, a nurse several hours to track down, organize, and summarize hundreds of pages of records they need. Anterior can do it in seconds, allowing clinicians to increase their output tenfold and focus on what matters most, helping patients. Love that mission. How do we know that LLMs, that AI, is going to make the right clinical decisions?
That's a great question. And that's because you never let the large language model make the clinical decision. That is the key bit here, which is everything up until the clinical decision is the bit that takes the most time and the most effort. So if you look at the nurse's workflow, right, they'll spend kind of 95% of the time logging into the 20 different systems, right, downloading the right PDF files, finding the clinical reference and documentation and guidelines, mapping it all out, finding needles in a haystack across hundreds of pages, to then just have all the information gathered so that he or she can make that decision, right? So what we tell our nurses that use the product, and the reason they love it is like each one of you gets an intern that overnight, a really smart intern that overnight has prepped all the notes, right? Has gone through everything and then lays it up for you so you make the call, right? And what that is you ensure that nurses and doctors go through administration much, much faster, but they focus on the bit that they're great at, the top of their license, the thing they went to medical school or nursing school for many years for.
So I want to know about training these models, because there's a big issue when it comes to what this stuff is trained on. How do you do this when patient data is confidential?
Yeah, so flat out, we absolutely don't train on any customer data. And I don't think companies would even allow you to, right? So that's all in the contracts that we sign and so on. I think the world has moved on in the sense of the previous issue with AI was that you needed to train a lot of medical data to even have something viable. But I'm sure you've seen ChatGPT passes the USMLE and all these things. A lot of these general models that we use off the shelf, right? They're actually pretty good clinically. The trick is that last 10% though, and the reason why ChatGPT isn't doing any of this stuff today is because it maybe gets 60% of the way there. How you orchestrate them, how you get multiple large language models, including also built on top of the decades of machine learning progress that we've had, on top of databases and other kind of computational techniques. How do you stitch that all together in an end-to-end experience? That feels like almost like kind of completes the picture with a great user experience as well. That's the bit we focus on. That's the bit that actually delivers.
Well, let us know how things are going. Dr. Abdel Mahmoud, Chief Executive Officer of Anterior, joining us in New York. This is Bloomberg Business Week.
listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week. What would you like to hear about on Bloomberg Radio? Help make shows like ours even better by taking our Bloomberg audience survey. Visit youtube.com/Bloomberg Podcast, then click the link in our profile or community section to take the survey. It's hosted by our partners over at Material. You can fill it out now at youtube.com/Bloomberg Podcast.
Ask for whatever you want, but be sure to include more Carol and more Tim. That's what we're going to say. That's it. Put anything you want, but just tag that on as a PS.
Carol and Tim need more snacks. Bring us more snacks.
More snacks.
Yeah.
More cowbell. All right, let's get to a story that came after the closing bell. It's certainly catching our attention. A judge blocking the planned $8.5 billion acquisition by Tapestry, maker of Coach and Kate Spade handbags, of rival Capri Holdings. We do see Capri Holdings down about 50% in the aftermarket, moving to about a $20 a share stock. Tapestry is rallying in the aftermarket, up about 12%. All right, so let's get to it. What's going on here legally? Bloomberg News legal reporter Bob Van Voris joins us on the phone in New York City. Bob, what's the justification for this U.S. district judge who blocked the deal?
Well, the judge ruled that there is a separate market in accessible luxury handbags. Those are the kind of bags Coach and Kate Spade, Versace, and Michael Kors that inhabit that sort of middle range between mass market handbags that you buy in department stores and your true luxury handbags that cost more than $1,000 or often manufactured in Europe. The Judge Rochon, ruled that a merger in this case would result in 59% of those sort of middle range bags being marketed by the same company, and said that was going to likely to harm competition. So as a consequence, she has blocked temporarily the merger and will let the Federal Trade Commission go forward with its own process that could take months and could kill the deal outright.
I'm just going to read to you a comment that I got from a Bloomberg subscriber who sent me a message on IB when we broke the news on Bloomberg Television a little earlier. He writes, "Thank God, could you imagine the monopoly in mid-price handbags made in China, what that would do to the consumer?" Obviously, he's being facetious there, but he raises the point of, like, who this is protecting.
Well, absolutely. The companies came in and, in a week-long trial, they argued to the judge that there is all kinds of competition in the handbag market, that people will substitute up and down with more or less expensive handbags. But the judge didn't buy it. She found that there was this distinct market, and that if she allowed this deal to go forward, it would damage competition.
All right, so I'm assuming, is this done? Are they going to fight it? What's next?
The parties are likely, they may well appeal, and if they are unsuccessful, they would go forward with a trial in front of the FTC, and the FTC would make its own ruling. The parties argued that they shouldn't be forced to do this because that process would effectively just kill the deal. The time that it would take for them to go through the trial would make it commercially no longer viable for them to go forward.
Okay, so what do these companies now do at this point? I know you're covering it from sort of the legal angle, obviously, but is this, they just have to go it alone?
Well, it's a very good question. The FTC has said, that's nonsense. If it was a economically attractive deal, right now, it's going to continue to be that way. And so we don't know yet whether they will try to resurrect something from this deal or just walk away and go back to competing.
Does it say anything about other companies that might try to combine in an environment where we know the FTC is very closely watching companies that are trying to hook up and looking, it's just kind of tough, if you will. So I'm just curious, are there any other, does this send a message to the corporate environment?
Well, the FTC's record in trying to block deals has been sort of mixed. This is a very big win for them. This is their first foray into the fashion industry, and it's a very big win for them. Certainly, companies are going to be wary and very attentive to today's news, and possibly a little bit more cautious in structuring their deals.
This has serious implications, as you and Chris write. It was a closely watched case by hedge funds and other investors betting on whether the judge would allow the merger to proceed. That's a really interesting part of the trade.
Why? Yeah. Why were they watching so closely?
Well, look what happened look what happened now. Capri's down more than 50%. That's a huge, huge move.
Absolutely. And there were, as a consequence, there were a lot of arbitrageurs and,